There are no two ways about it. The S&P 500 index had a remarkable performance last year, rising almost 29% in 2019. I'm pretty sure that most investors would find that to be a hard performance to beat, but in this video, we're going to show you an extremely simple options trading strategy that, if implemented carefully, could have performed more than twice as well as the S&P 500 index did last year, and that's saying something. I'm the head trader of SMB Capital's options trading desk in Manhattan. I can tell you from experience that most traders and investors just don't think that certain returns are possible. But options create unique opportunities for profit that most other trading instruments just can't deliver. So if you're interested in an easy to learn strategy that could have beaten the market by more than 100% in the stellar 2019 equities market, then stick around, because I think you're going to be pretty surprised at how easily this could have been done. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for the traders and investors all over the world. They're really very valuable. Okay, so one of the great things about options income strategies is that they can be adapted to accommodate trading signals, so that the combination of a simple option strategy and a commonly used trading signal can be incredibly powerful if you know how to apply them together. Now, in the case of the equity markets, one of the most widely watched indicators is the 200-day moving average. When it's breached to the downside, many traders fear that a bearish trend has developed, and so lots of traders tend to get bearish when that average gets breached. So let's say that you wanted to use that indicator as a signal to get in and out of bullish options trades. That could be a reasonable thing to do, and so I'd like to work through a particular option strategy known as the put credit spread, and let's study how it should have performed in 2019 if utilized in a certain specific and easy to understand way. Now, before we get into that, I just want to spend a minute to make sure that everyone watching is up to speed about the basics of the way options work, so that they can follow this study that we did and realize why it should have beaten the hell out of the market returns in 2019. Now, most of you are probably familiar with index options, which are the options that are used in this example, but there may be some who just have a passing knowledge of how they work. So I'm going to do a quick basic review of the basics so that you'll all be able to understand this strategy. For those experienced options guys out there, don't worry, this is going to be quick, and then we'll jump right back into the guts of the lesson. So you're probably all familiar with how equity options work. With equity options, a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares of stock at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except that there's no such thing as 100 shares of an index like the S&P 500, so you can't really buy or sell 100 shares of an index, but what you can do is get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So, for example, if the SPX index is trading at 3,000 and you buy the 3010 call, if the SPX goes to 3015, you should receive $500 in your account. If the index closes at 3,010 or lower, your call expires worthless. On the other side of the ledger, if you buy a 2985 put and the market sells off to 2975, you'd make $1,000. But if the market just sold off to 2985 or higher, the put expires worthless. So those are the basics of index options. Now, it's important to be clear on what index options are, because we're talking about a strategy that we want to compare to the performance of the S&P 500 index in 2019. So we're going to use index options to implement this strategy. Okay, so first of all, we could establish a rule that the trade will not be implemented unless the S&P 500 index is trading above its 200-day moving average, as that's a bullish trade. And furthermore, when we do implement the trade, if at any point during the trade the market closes below the 200-day moving average for more than 3 days, then we can see that as a signal that the market is probably going to turn bearish and thus close our bullish trade and wait for another opportunity to get back involved in the trade once the market remains above that 200-day moving average. So let's take a look at the chart of the S&P 500 in 2019. As you can see, the first time the market moved above the 200-day in 2019 was in early February. Remember, the market had a hard sell-off in the final quarter of 2018, so it took a little while for that to be overcome in terms of the moving average. So let's suppose that when we're in this condition, when the market is above the 200-day moving average, we could enter into a put credit spread way below the market for safety. Now, virtually every broker that allows you to trade options provides you with some metrics on the options you're trading, and those metrics are called the options Greeks. The options Greeks are various sophisticated measures of how options react to changes in the price and volatility of the underlying stock or index that the option is derived from. So one of those Greeks is called an options delta, and it's basically measuring how much the price of an option should move based on the movement of the stock or index that the option is derived from. The farther an option strike is from the market price of whatever you're trading, the smaller its delta is. So for example, if the SPX index is trading at 3,000 and the strike price of a put option is at, say, 29.95, just 5 points below the price of the index, then that option will have a delta of around 50. But if the strike price of the put is 2,800, 200 points below the market, then the delta could be as little as 5 or 10, depending on how far the option is from its expiration date. So that's a very high-level summary of deltas. Okay, so getting back to our trade, if we have a protocol that as long as the market is above its 200-day moving average, then we're going to sell a put at 10 delta, way below the market price, on an option that expires in 60 days. In other words, 2 months from now. So in 2019, the first opportunity we could have had to do that should have actually been February 12th. So on that day, the SPX was trading at 27.45, and the 10 delta option was way down there at 25.75, 170 points below the market. So on that day, we sold 10 of those 25.75 puts for $19.25 each. Below that, we bought 10 points lower, 10 of those 25.65 puts for protection at an $18 price. So if the market really starts to sell off, that long put at 25.65, it gets activated as a protective hedge against the short put options we sold 10 points higher at 25.75. Now, let's drill down and try to understand what exactly is going on here and how this trade works. So this formation where we sell a put way below the market and then buy a put even farther down from the market as protection, that's known as the put credit spread. Now, let's take a look at how this works. When we sell the 15.75 put, we receive $19.25 times 100 times 10, because we sold 10 of them, so we received $19,250. Then we moved down to the 15.65 puts that we bought, and you'll see that we had to pay $18,000 for the 10 of those, netting us cash flow of $1,250. Now, your broker, for margining purposes, should require you to have about $8,750 for this trade, which is the worst case scenario loss on the trade, by the way. So therefore, that's really the capital that we've invested in the trade, which makes sense because the puts we sold are so far from the market, 170 points below the market, in fact, that the market has to take quite a dive for either of those options to be activated. And so the risk in the trade is larger than the reward, but the reward is very, very likely to happen because in only one instance where the market goes down a lot do we lose on this trade. If the market goes up, goes nowhere, or goes down modestly, we should win the trade, as you'll see in a minute. Now, the rules of the trade are that we should stay in the trade as long as the market stays above the 200-day moving average, as we mentioned. If it falls below the 200-day, then we should wait 3 days, and if on the third day it closes below the 200-day moving average, we would close the trade. That way, We avoid the noise of a small market move below the 200-day, which gets bought up quickly. But if the profit on the trade is greater than 90% of the original cash credit that we received, we should close the trade for a profit. So now let's move forward to March 28th. And as you can see, we're still in the trade. The market did very briefly move below the 200-day moving average, but it quickly rebounded, so we didn't hit out of the trade. So now on March 28th, we're only 15 days before these options expire, and we've been in the trade for 45 days. So let's analyze where we are exactly on the position. Being 15 days from expiration, you can see that the prices of the options have dropped quite a bit. The 25.75 that we sold for $19.25 is now down to $1.15, and the 25.65 that we bought for $18 is now down to $1.05. So at this point, you'd close the trade, and let's run through exactly why you'd close it. So originally, you'll remember that we received $1,250 for the combination of selling the 10 25.75 puts and buying the 10 25.65 puts. We netted $1,250 out of that transaction. Well, what if we wanted to close the trade? Well, at this point, we'd have to pay $1.15, the market price of the put now, to close our short position at 25.75, and we'd be able to sell our long 25.65 for $1.05. So if you do the math, we take our original $1,250 that we received, we spend $11.50 to buy back the 10 short puts at 25.75, and we sell the long puts for $10.50. So we're left with cash of $1,150. Well, remember we said we should close the trade when our profit has attained at least 90% of the credit we originally received. And as you can see, we can close the trade for a 92% credit. And so therefore, we'll close the trade and pocket the $1,150. Now, since we're still above the 200-day moving average, we could simply reopen another trade as soon as an options chain opens up, which is 60 days out. And that happens on April 9th. Now, on that day, the SPX had rallied up to 28.77 and was still well above the 200-day moving average, so we could go ahead and sell the 27.15 puts, which are the 10 delta puts we talked about, and buy those 27.05 puts for protection. Now, you'll notice we receive $19.40 for the 27.15 puts, and we'd have to pay $18.35 for the 27.05 puts. So if you do the math, we'd receive $1,050 credit this time for an initial investment of $8,950. Now, before we run through how this trade worked out, as well as the equivalent trades for the rest of the year, I wanted to mention that we're currently running a 2-hour free intensive workshop at the moment where I'll be teaching you 3 real-world option strategies that professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies are of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That should open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just go on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now we've entered our second trade in our 2019 put credit spread campaign, and you'll see that we've moved forward to June 5th, and the SPX is actually sold down to 2018, but with only 3 days left and the puts being more than 100 points below the market, there would have to be a hell of a sell-off for those options to actually pay off. And so the market was assigning very little value to them. Well, again, we reached the point, as you can see, where we can close the trade for, in this case, so little that we were able to hang on to 95% of that original $1,050 credit, because it only cost us $50 to close the trade. And as long as the SPX stays above the 200-day moving average and doesn't close below it for more than 3 days, we should throw on another trade 60 days out from expiration. So it turns out that the conditions were acceptable according to our trade standards 4 more times during the year, in early June, in late July, in September and November of 2019. So we were able to execute the trade 6 total times during the year, of course only when our conditions were met. And here are the results. With a little under $9,000 deployed on 6 trades spread throughout the year, the results were obviously impressive. A 67% return on capital. Mind you, we were out of the market for a number of months where our trade standards were not being met. That's well more than twice the incredibly impressive 29% returns of large cap stocks in 2019, where you'd have to have been in the market the entire year to appreciate those kinds of returns. So what I'd like you to take away from this video is the fact that it can be extremely powerful to combine the principles of options income trading with market indicators like the 200-day moving average, as we did with this simple put credit spread program triggered by the market trading above the 200-day moving average. When you do this, you can get surprisingly superior results compared to the performance of the underlying indexes if you understand how to position your long and short options in the statistically correct locations in relation to the market, and have the discipline to stick to your trading playbook because you have confidence that it should work out from backtesting and live trading experience. Just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, and you'd like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That should open up the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now I'm interested in hearing from you. What indicators do you use in your trading that you think might lend itself to options income strategies such as the put credit spread? I'm really interested to see what you'll suggest. We'll do another video like this to test out the best ideas we get, showing how we could apply options income strategies to express the directions suggested by your indicators. And let's see what happens. I'm really looking forward to what indicators you'd suggest, so please comment those below.